Hello everybody and welcome to the next video in our series exploring the theory of the firm. Now, towards the end of the last video, this is where I'd left you off really, looking at short run production. So it was this idea that in the short run, at least one factor of production will remain fixed. So what we know is in the short run, firms will benefit from increasing marginal returns. So when they add additional units of variable factors of production, add them to fixed factors of production like capital, then they will originally see marginal products increase, but then eventually they will suffer from diminishing marginal returns, where adding more labour to fixed capital will result in problems such as crowding, congestion and chaos. What we're going to move towards in this video is looking at what we call long run production. And as a reminder, in the long run, all inputs, so all factors of production now become variable. So firms in the long run can scale up even things like capital, so machinery, infrastructure, etc. And that means they can overcome the problems of diminishing marginal returns. So as a reminder, everyone, long run production, all factors of production now equal variable. Now, what we need to do is to understand the relationship between short run and long run production. Now, in the previous video, we ended really by looking through this bottom diagram here, where we plotted marginal cost and average total cost. Now, what I'm going to do, I'm going to take those diagrams and bring them down onto a long run production curve. So look, we've got here. So I'm now going to label this short run average total cost curve 1. Now, what we know is in the short run, as firms scale up production, they will originally benefit from increasing marginal returns. So their marginal cost curve will therefore fall. But then when they suffer from diminishing marginal returns, then the marginal cost curve will start to loop back upwards again. So look at that then. What we know is in the short run, firms benefit from increasing marginal returns, but then once they scale production up beyond a certain level in the short run, they suffer from diminishing marginal returns. Now remember that marginal cost will always cut average total cost at lowest ATC. And that was the idea that when marginal cost is below the average cost, then it will bring down the average cost of production. But when marginal cost goes beyond average cost, it will suck it back upwards again. Now, the logic would be that if the firm is starting to suffer from diminishing marginal returns, they've got to scale up production in the long run. So the example we gave was in the short run, a Subway sandwich shop. As they add more and more units of labour, they originally benefit from the increasing marginal returns, but then they suffer from diminishing marginal returns. The idea was that adding too many units of labour to fixed capital created problems such as crowding, confusion and chaos. And that led to inefficiencies creeping in and costs shooting up. Now, the idea is now the business ultimately is no longer fit for purpose. They're trying to produce too much output from their fixed capital. So in the long run, what the firms can therefore do is to scale up production. So this could be Subway, building a bigger restaurant, adding more capital to the production process. And as they do that, they will now have a completely new average total cost curve and marginal cost curve. So what you'll hopefully see here is on this new cost curve, their average cost of production are lower than what they were before. We'll think about why in a few minutes or so. But again, that whole process will now start again. So as they start to add more variable factors of production to fixed factors of production, they benefit from increasing marginal returns. But then eventually those diminishing marginal returns kick in. And as they do, again, it will be time to scale up production. And again, that whole process will start again. But look what's happened. Again, their average cost of production now lower than what they were before. But then something weird will happen. As they scale up production again, we may now see short run average total costs start to move in the other direction. So we've got all of these different short-run average total cost curves. Now, if I want to plot the long-run average total cost curve, all I do, I take the gradients of all of these short-run average total cost curves. And what this purple line is now showing is the long-run average total cost curve. Now, hopefully, what you can see here is, again, that this curve is taking on the shape that it was with the short-run average total cost curve. We've got a period of time where average total costs are falling, and we've got a period of time when average total costs are starting to increase again. And again, when we operate at lowest average total cost, we're achieving productive efficiency. Now, that's where a business wants to be, because if they can operate at lowest average total cost, that's when they are the most competitive. They can produce things at the lowest possible cost. That means they can lower prices or they can make more profit. Obviously, if they're efficient, it should be beneficial for us as consumers as well, because hopefully that would translate to lower prices for us as consumers. Now, what is happening here is when long-run average total cost is falling, the firm is benefiting from economies of scale. But when average total costs start to increase in the long run, the firm is now suffering from diseconomies of scale. So everyone, the main takeaway point from this slide here, though, is that the envelope curve, this long-run average total cost curve, it shows us that the LRATC is made up of all of these short-run average total cost curves. Now, what I've now done here, I've shown you the same diagram minus all of these short-run average total cost curves. So what we can see here then is that originally, when firms scale up production in the long run, so they're increasing capital and all other factors of production, they're going to see a long-run average total cost fall. Now, what we've got here is something that we call internal economies of scale. As the firm scales up production, they're benefiting from reductions in average cost of production. They're becoming more efficient. Now, this is because of something that we call increasing returns to scale. In the long run, as firms scale up production, the growth in outputs exceed the growth in inputs. So increasing return scale, scaling up production. So for example, from Q1 C1 to Q star, we'll see average cost of production fall due to the growth in outputs exceeding the growth in inputs. So this growth in efficiency. And the cost benefits of this are what we call internal economies of scale. When the firm gets to Q star, they're working at lowest long-run average total cost. They're being productively efficient. But then after that point, we'll see that long-run average total costs start to increase again. And this is because of what we call internal diseconomies of scale. So scaling up production now is seeing long-run average total cost starting to increase. This is what we call diseconomies of scale. So it's decreasing return to scale. So what's happening now is the growth in inputs is greater than the growth in outputs. So the idea is in the long run now, the firm is becoming less efficient in the long run. So those average total costs are now starting to increase upwards. Now we will explore internal economies of scale and internal diseconomies of scale in a moment or two. But I want to show you this diagram in a couple of different ways. Now, what we're assuming here on this diagram is that we get this U-shaped long-run average total cost curve. So we're going to benefit originally from internal economies of scale as we scale up production. We then get to the productive efficient output. But by the way, we also call that a minimum efficient scale, which we'll come to in a moment or two. But when we go beyond that point, then long-run average total costs start to increase again, and we get the diseconomies of scale. Now, we can show this, though, in different ways. Some businesses, as they scale up production, will have a long-run average total cost curve like this. Now, when you look at this firm here is not suffering from any diseconomies of scale. So as they scale up production from Q1 to Q2, they've got these wonderful internal economies of scale. so reductions in long run average total cost. And if they scale up production to Q3 again, there will be a further reduction in long run average total cost. So they're benefiting from more internal economies of scale. So this firm is only seeing average total cost of production fall as they continuously scale up production. The one on the right hand side, I'm going to draw in this way. Now, this is something which is probably more likely in the real world. As firms originally scale up production, again, in the long run, they benefit from internal economies of scale. And then there's a range of output levels where they operate at lowest long run average total cost. So here, this business, any output between Q1 and Q2 would be achieving productive efficiency. But then when they go beyond Q2, they're suffering from internal diseconomies of scale. Now on this diagram, I want to point out to you as well, this point here. We call this minimum efficient scale. This is the lowest output level that a firm's got to get to have fully benefited from internal economies of scale. So lowest output possible to get to productive efficiency. So this firm must get all the way to Q1 to fully benefit from internal economies of scale. Right, anyway, everyone, I've spent a lot of time showing you the diagrams which shows the benefits of internal economies of scale. But what we now need to do is to think about what internal economies of scale actually are. So again, look at the diagram. As this firm scales up production from, let's say, Q1 to Q2, then average total cost of production are falling. These are the internal economies of scale. So the cost advantages, if you like, of scaling up production, a reduction in long run average total cost. Now you've got on the screen here some different examples of internal economies of scale. Now the first one I've listed down is something called purchasing. Now in effect, the idea is here, as firms scale up production, they can do more what we call bulk buying. So the idea here is, everyone, that ultimately the bigger the firm is, the more able you are to put in large orders with suppliers. And this often means that you can negotiate larger discounts than what smaller businesses can benefit from. So a good example would be a supermarket chain like Asda. When they put in their orders with milk with dairies across the UK, they've got more buying power than small independent corner shops, etc. So they can often negotiate cheaper prices for things like milk than what smaller businesses can do. So this is the benefits of being big, this ability to bulk buy things in bigger quantities to negotiate cheaper discounts. The logic is that the suppliers would rather deal with these big businesses because they can sell them a bigger output level. So the big supermarkets, these big firms, are able to therefore negotiate cheaper discounts. We also call this monopsony power. Now, a monopsony is a sole buyer of a good or a service. So the NHS, for example, supplies healthcare for more or less the entire nation. So when they contact bandage manufacturers, medicine companies, etc., because they're buying more or less the entire output that firm produces, they're able to negotiate bigger discounts than what smaller businesses will be able to. So these are the ability to negotiate cheaper deals with suppliers. Now, technical. This one really is linked to machinery and research and development. Now, the idea is that when you buy machinery, it's often a fixed cost. But because bigger businesses are producing such a high level of output, they're able to spread the cost of buying that machinery over a much bigger level of output. And that makes it cheaper. So these firms can upscale production and make bigger investments into technology than what smaller businesses can. So this could be McDonald's, for example, buying the checkouts where customers can input their own order into the machines. It could be car manufacturers buying production line machinery. Smaller firms cannot justify making those big expenses. Bigger firms can spread that research cost over a much bigger output level. So the bigger the firm is, the more able they are to exploit technical economies of scale. Now, marketing, this is the idea that, when firms advertise, etc., bigger businesses, when they put together expensive advertising campaigns, they can spread that advertising cost over a much bigger customer base than what a smaller business would be able to. So, for example, let's stick with McDonald's advertise on TV, they can spread that huge advertising cost over a massive customer base. It brings down the average cost of those campaigns on TV. Smaller, more independent fast food companies cannot justify those big expenses. So for bigger firms, the average cost of these campaigns is far cheaper. Now, linked to this, there is something that we call economies of scope. Now, you tend to find that bigger businesses have got more brands. And because they've got more brands or more products that they offer, when they put advertising campaigns on TV, that advertising campaign will cover more brands, more products. And therefore, it will appeal to more customers than advertising campaigns for smaller businesses. So again, they're going to get some cost benefits of that. They can spread that really expensive campaign over a much bigger customer base. So a good example here could be Nike. If Nike put an advert on TV, because they've got such a massive number of products underneath that Nike umbrella, from golf to football shirts to football boots to hockey equipment, etc., basketball tops, that advertising campaign will appeal to more customers, and therefore they can spread that really expensive campaign over a much bigger number of customers. Now, financial. I'm thinking here about borrowing money. You tend to find that bigger businesses can borrow money from banks at lower interest rates than what smaller firms can do. And that is because they are deemed to be less risky. So the idea is bigger firms can borrow at cheaper interest rates than what than what smaller businesses can. So because of that, they've got these reduced borrowing costs, and therefore again, it's going to create another internal economy of scale. The reason why bigger firms can often borrow at lower interest rates is because they're less risky, because they've got more collateral. So they've got more assets they can use to pay back the lender if they were to fall on financial problems. So they're more able to access the funds they need to invest and expand and grow, but also they get lower interest rates because of it as well. Now, the next one is something called risk bearing. Now, the idea is that bigger businesses are often able to be more dynamic than what smaller businesses can. And that's because when a big business takes a risk on a new product, a new market, a new piece of machinery, something that might make them more productive, then if it doesn't pay off, there's less of a risk to the overall success of the business than what there would be for a small company. So bigger businesses are more able to absorb the problems of risk taking in terms of, if it fails or not. So because of that, bigger businesses are more able to be more dynamic and invest into more ways to become more productive than what smaller businesses can. The last one, specialisation and division of labour. Now, because bigger firms have got more jobs that need to be completed and they're producing more output, they can often employ specialist staff. So they can employ, expert research and development managers, production line managers, human resources specialists, marketing experts. Because they can attract and employ these hugely highly qualified people, they're often able to find more ways of improving productivity that smaller businesses would not be able to do. So everyone, when we think about internal economies of scale, we're thinking about the benefits of being big in the long run. A bigger output level enables you to bulk buy, benefit from cheaper suppliers than what smaller businesses can. Technical, you're more able to invest into better technology and capital. You're more able to justify bigger marketing campaigns. You can borrow money at lower interest rates than what smaller businesses can. You're more able to take risks and therefore be more dynamic than what smaller businesses are. And also, you can employ specialist staff with high skills. These people will find really, really good ways of raising productivity further within these businesses. Right, okay, now let's think about the opposite though. Can businesses get too big? Well, yes, they can. Look at the diagram. What we know is that for a firm, when they raise output towards QStar, they benefit from internal economies of scale. But if they were to go beyond Q star, they start to suffer from what we call internal diseconomies of scale. So long run average total cost of production start to increase. Now, this is the problems of being too big as a business. Now, some of the problems stem from poor communications and coordination. Bigger businesses have got a vast workforce, and you tend to find that workers now work in very specialised departments. They don't communicate with other departments across the business. It's very difficult to coordinate all the different jobs that all these different departments are doing. These staff don't talk to each other. They don't share ideas so much of what smaller businesses do. And these things tend to slow down production. It's a problem of Chinese whispers, ultimately. There's more layers of management that we've got to pass information through. It's difficult for managers to receive regular feedback from lower down staff. And these things make communication and coordination more difficult. And that creeps in inefficiencies. And that means that average cost of production start to increase in the long run. Another problem is poor staff motivation. The idea is the bigger a business is, the less important and valued staff can often feel. And that is because they're so remote, so detached from decision making, they don't feel valued, they don't feel important. You feel like a really small cog in a big machine. You know, staff that work in Amazon often complain about this problem. They're so insignificant to the overall business that they don't feel valued, they don't feel important. And that often means that staff's productivity is often low. You also find that these businesses often struggle to keep hold of staff, so staff retention is low. They've constantly got high staff turnover, people leaving the business. So this is a big problem which could lead to productivity falling and therefore long run average cost of production starting to increase. Now the last one is something that we call the principal agent problem. And this is linked to something that we call a divorce of ownership and control. Now the idea is the bigger the business, the more likely that the people that run the business are not the owners. So the owners might be the shareholders, whereas the people that run the business or control it are the managers. And what you tend to find is that in bigger organisations, the managers and the shareholders might have conflicting objectives. So the people that run the company are more in it for their own gain, you know, higher wages, higher perks, better terms and conditions for their own contracts. And that might mean they're not looking to maximise productivity and efficiency to maximise profits for shareholders. And this is something that's more likely to be in a big organisation where you've got this detachment of ownership from control. Smaller businesses, the owner is often the person that runs the business. So they're singing from the same hymn sheet. In bigger organisations, this becomes far more difficult to achieve. So guys, what you've got there so far are internal economies of scale and internal diseconomies of scale. It's worth noting, everyone, that these things exist when businesses grow themselves. So as firms scale up their own production, then they will first of all benefit from internal economies of scale, but then they suffer from internal diseconomies of scale. What I now want to think about is external economies and diseconomies of scale. Now look at the diagram first of all. We're not looking at the firm expanding their own production this time. We're looking at the industry growing. So the benefits of the industry growing is what we're looking at this time, and the benefits it will create for the firms that operate in that marketplace. So look what happens now. We're going to get a reduction in average total cost of production, but the firm hasn't got to expand their own sales to benefit from these things. Now, a good example could be there's better infrastructure in an area. So imagine if you're a supermarket and the government spends a fortune upgrading transport links. Well, that was going to create some huge benefits for you as a firm in a marketplace. You're now going to have cheaper distribution costs. You can now maybe attract better workers from faraway places due to reductions in geographical immobility of labour. So you become more productive. So you haven't had to scale up your own business to benefit from these things. But if there's better transport in place, you've got better workers you can choose from. But also your cost of shipping goods across the country are now lower. So you're gaining cost advantages from benefits outside of your business. It could just be as well that as the industry grows, there's a bigger access to skilled workers. So a good example is if there's a growth in the number of people gaining STEM-related qualifications, so science, technology, engineering, or maths, then firms that need them workers with those skills will benefit from them workers gaining those skills. So a good example, AstraZeneca, that makes pharmaceutical equipment, recently relocated production to Cambridge. And what they're benefiting from are more skilled workers in their area. These workers come in, they're more productive, there's less training costs, and it helps the business become more productive without having to scale up production any further. It could just be that in the marketplace there's better technology. So when you think about AstraZeneca again, pharmaceutical companies, AstraZeneca, have been creating vaccinations against COVID-19. Well, the logic would be that as technology improves in that industry, all the firms that operate that industry will benefit from these automatically. So guys, look at the diagram, man. External economies of scale are the cost benefits that happen due to improvements in your industry. So better transport links, better skilled workers, more technology in the industry will mean that you can cut your average cost of production without having to scale up production. Let's now think about the opposite, external diseconomies of scale. So these are the problems that happen when a market grows and why average cost of production might actually increase. So look here what happens. The firm has originally been productively efficient at Q1, and the average cost of production is C1. But then this happens. The average cost of production increase due to the market growing rather than the firm growing in the marketplace. Now, this can happen because of things such as labour shortages. If an industry grows or a market grows, it might make it more difficult to get hold of the right workers. That could lead to a growing demand for labour and force up wage rates. Well, that would raise costs and therefore raise the average cost of production for firms. It could also mean that firms have got to recruit, less skilled workers, and that could lead to higher training recruitment costs. And that again would lead to the average cost of production increasing due to external diseconomies of scale. Now, linked to that, you've got resource competition. So if a market grows, the resources that industry requires will now start to become more scarce, more difficult to get hold of. And that would bid up the prices of those resources and therefore increase the average cost of production for firms. So, for example, if you think with COVID-19, if you've got a growth in the market for vaccinations, then I suppose in theory the chemicals that go into them vaccinations will be in higher demand, and that would bid up the costs of production for businesses. Okay? Right, anyway, everyone, what I now want to do is to bring together long-run production. It's just to recap on the diagrams. So let's think first of all then about the classic long-run average total cost curve. It's this U-shaped LRATC. What we know is when firms operate at lowest average total cost, they're achieving productive efficiency. As they scale up production in the long run towards Q star, they're benefiting from internal economies of scale. So those are the things like the purchasing, the financial economies of scale that are benefiting the firm, the benefits of making your business bigger in the long run. But then when you go beyond Q star, you're suffering from internal diseconomies of scale. And these were the problems of coordination, communication problems, workers feeling demotivated because they don't feel important enough. We can also show this diagram in different ways. What we know is some firms will never see diseconomies of scale creeping. As they scale up production, they're only going to see more and more internal economies of scale. Or what we could do is have this bucket-shaped LRATC curve. Now again here, we can see the benefits of internal economies of scale, the problems of internal diseconomies of scale. But the difference now is there's a range of output levels where the firm is achieving productive efficiency. And Q1 would show minimum efficient scale, the lowest output the firm must get to fully utilise the main benefit of the internal economies of scale. What we can then do is to show external economies of scale. So the cost benefits for a firm of the market growing or improvements in their industry. So look what happens here. With the same output level, as the market or the industry grows, they've got these cost benefits of it. So average cost of production falling. And of course, what we can also show are the internal diseconomies of scale. So we've got here long run average costs increasing due to problems within the industry growing. So resource competition, labour shortages, etc. So I want us to bring together the end of what we're looking at then here. What we did towards the end of the previous video, we ended with this. So the 3 diagrams for short run production. So showing the benefits of increasing marginal returns and then the problems of diminishing marginal returns. Those are short run concepts. In the long run, firms benefit from internal economies of scale, but then internal diseconomies of scale. But firms can also benefit from external economies of scale, but also suffer from external diseconomies of scale. So guys, these are the main diagrams to take away from this video. Right, everyone, I will stop there. So thank you very much for watching.